Hello guys, welcome back. This is the last video of section B, part 1, planning, budgeting and forecasting. Okay, so today we are going to discuss balance sheet, budgeted balance sheet. Okay, this is me RABEEH OVUNGAL. Welcome back to EduCafia. So in the last videos, we were discussing about all these budgets. Today we are going to discuss budgeted balance sheet. So this is the budgeted balance sheet of June 13th. So for preparing June 13th budgeted balance sheet, we also required last period. Last period means last quarter, which is the last quarter, March 31st. So March 31st balance sheet also we required. So March 31st balance sheet also we are having. Because in the sum amount is this balance sheet are accumulating. So without this balance sheet we can't do June 13th. So something is saying here, company estimates that on June 30 the balance of office supplies will be 38,906 and tax payable, sales tax payable 7,812. So these two things already given. What is office supplies? That pen, pencil, paper, A4 sheet, everything is using in the company, right? That is office supplies. So that is also an asset of a company. So that is already given 38,906. So in June 13th, under asset, you can see office supplies. This 38,906 already given. And sales tax payable 7,812. That is also under current liability, sales tax liable, this. So these two guys already given. So other guys we have to find it out. Got it? So first one, accounts payable. In that first one, accounts payable, we can start it from here. Okay. So accounts payable, this amount how we got. What is accounts payable? At the date of June 13th, or June 30, not 31st, that is July 31st. So, okay, at the date of June 13th, if anything pending to pay because of purchase, that will come in accounts payable, right? We have to pay. So, we having a material purchase budget. We said whenever we purchase, of that 60% we pay within the month, balance 40% we pay next month. This is already we discussed in the cash flow statement, right? Yeah, cash flow budget. You remember, right? So, in June month, we having a purchase, budgeted purchase of 2,84,310. This one. Of this, 40% payment is pending, right? So if it is happening on June, we are going to pay in July, right? So that amount is 1,13,724 is pending. That is payable. That is our accounts payable. You got it? So next, this sales tax payable already we discussed it. Then income tax payable. How we got income tax payable? That we can get it from our income statement. Then income statement, we having April month also, we having this tax we have to pay. May month we have to pay this tax. June month we have to pay this tax. So total 1,02,564. This is we are not going to pay this month. This is we will pay after one year. Yearly only we will pay tax, right? So this is there in tax payable. If it is on yearly, 3 months, at least 3 months we will pay, right? So this is tax payable, that is there. Next, common stock. Is there any changes in the common stock? Is there any discussed? No. So there is no changes from the March 31st. So in the March 31st, what is there? In the March, this is the March 31st balance sheet. That what is there? That is there in the June 31st also. Sorry, 13th. You got it? Next one, retained earnings. In March 31st, we having a retained earnings of 6,04,000. What is retained earnings? Whatever in there in the income statement as the net income, the total net income, that will come to the retained earnings, right? And there is no discussing about dividends paid. Is there any discussion about dividends paid? No. If there is dividend paid discussion is there, means after deducting the dividend pays, we have to add to retained earnings. So this amount I am adding to retained earnings. So this will become 8,43,817. Very easy, right? So this 604,500 plus this 239,317, this is equal to 8,43,817. You got it? So we got this much things. Next, cash. From where we get the cash? From the cash statement. So in the cash budget, we are having quarter closing balance. Quarter closing balance means last month, June month closing balance. How much? 91,380, right? So that we will come in the cash section. Next, accounts receivable. Is there any pending to receive? Yes, lot of pending from the June month sale. From the June month sale, this is we discussed, right? In this 30% we are getting from onwards July. In this, how much? 3,15,000. Totally we can't take because we know 5% is bad after that we are not going to get. So balance one. This minus this 5%, that is this 47,000, this 2,52,000. That is we are going to get in July and August month, right? Not only that, in May month sale, some we will get in June. In this amount we will get 15% in July month. So this also pending. So this plus this, that is 2,52,000 plus this 47,250 plus this 33,750 is equal to 3,33,000. That is here. You got it? So next, raw material inventory. Is there any closing inventory? On June 13th, if there any inventory in the store, that will come in the raw material inventory. So is there any closing inventory? Yes. In the direct material usage budget, this is talking about inventory, raw material inventory, right? In that June month, we having a closing raw material, right? That is 28,018. That is our closing raw material. So that will come in the raw material inventory. Then FG inventory. This is talking in cost of goods sold. In that cost of goods sold, in closing FG, there is a 2,24,852 in June month. This is already we did. So that will come in FG inventory. Next, office supplies we already discussed. Land. Is there any discussion about land happened? So what is there in the March month? That is 14,000. That will be there in the June month. But because there is no discussion about land. If there is a discussion about land, like land is purchased, that amount also we have to add. Okay. Next, building equipment. Building equipment, that is 6,15,000. How it is got? Because in March 31st, you can see 5,96,000. This is becoming this. How it is becoming this? Is there any extra purchase happened in building? Yes, happened. In the question, we discussed the equipment purchased 2 lakh rupees. So 5,96,000. It is on March 31st. This is carrying value, not the building value, because already there is a depreciated from this. So the original value of this building, how much? This 5,96,000 plus this depreciation. Then that is equal to 7,64,000. That is the original value. To that value, I have to add 2 lakhs. Why? Because there was a 2 lakhs equipment purchased in May month. So that if I add the total value of that machine 9,64,000. Now I want to check how much depreciation will be there. That depreciation, we have to find it out from my manufacturing overhead budget and a non-manufacturing overhead budget. Here in manufacturing overhead budget, there is a depreciation term 30,000, 30,000, 40,000. Total 1 lakh depreciation is there, 1 lakh plus. In non-manufacturing overhead, two depreciation is there. Here also one depreciation, here also another depreciation. So the total 16,000, here it is 21,000. So 16,000 plus 21,000, total 1,81,000 depreciation is there in this period. In this period, previous in March 31st, there is a depreciation 168. So that 168 plus 1,16,000, 21,000. In this period, 1,81,000, we will add it. That is equal to this period total depreciation, including previous depreciation, 3,49,000. So we found this is the value of the building, total. This is the depreciation. So from that building value, we will deduct the depreciation. We will get 6,15,000. That is 6,15,000. So this is how we prepared June 13th budgeted balance sheet. Very easy, right? Very easy. So asset side and liability side should match. Okay, that is matching. So this is the budget, how to prepare, and here the section B part 1 ends. So you have to read the textbook, is very, very important, and do questions in the beginning times. It will like you will not get the questions properly. It will take time, so don't demotivate it. Okay, see you on next section, section C of part 1, next video. Bye bye.